All right, everybody, let's go ahead and do a sound check. Welcome out to Tackle Trading's Hard 14. This is a Tackle Trading 101 presents that we like to do every now and then on YouTube. My name is Coach Matt. Let me pull up my video, say hello to everybody. Hello, everybody. Excited to have you guys here. Just by way of a quick introduction, because most of Team Tackle knows who I am. I'm an entrepreneur, trader, and investor, one of the founders and CEO of Tackle Trading. I'm also the founder, one of the founders and co-host of the Trading Justice podcast. I'm a coach, I'm a mentor, but most importantly, I am a father and a husband, and I am excited to bring to you tonight a discussion we had with our community last week on Thursday on the Hard 14, the latest addition to our premium systems at tackletrading.com. And for those of you who are maybe unfamiliar with Tackle Trading, we're a community of like-minded investors and traders helping each other navigate the financial markets together. We have a tremendous amount of educational products. We also have application out there as well. We were founded in 2014, and from 2014 until today, we are hashtag Team Tackle, and we love being part of this community. We love as coaches being leaders in this community, and our Tackle Trading educational ecosystem can be fairly advanced and complicated because we have a lot of different offerings at Tackle Trading, but the subscription, the pro membership subscription, has a tremendous amount of value in it. We put out a lot of newsletters, shows. We do webinars every day called the Traders Lounges. We do coaches shows at night. We have a tremendous amount of basic level, Tackle 101 type level educational content as well. We put out blogs, tools for traders. We have a social media channel that we like to communicate with our pro member community on Discord. And for those of you who are unfamiliar with Tackle Trading, you can always get a free trial membership at bit.ly/join tackle pro if you want to be a part of our rich and growing community. And we love new members of Tackle Trading, and you're definitely going to get that red carpet treatment when you come to Tackle Trading. We love treating all of our members with the utmost respect and give them the help that they need to navigate the financial world. But for tonight, we're here to present the latest premium system. And as Tackle Trading goes, many of you understand this, but about twice a year, we put all of our premium systems, which are classes, specific content, on discount. We do one at the first of the year during our holiday sale season for Christmas and New Year's, and then we do one on the 4th of July as well. And for the next week and a half or so, every one of our premium systems, from the Bear Market Survival Guide, that's been very needed this year, to cash flow condors, to the swing trading system called the STEP method, stop loss target entry, position size, that's all swing trading. And now the latest premium system, the Hard 14, that Coach Mark Justice has put together over the last year or so and has been researching over the course of the last 12 years or so. And the Hard 14, like many of our premium systems, has 6 modules to that. There's over 7 hours of content from module 1, just the basics, all the way to module 6, getting into momentum in motion. So important. One of the concepts we're going to discuss here tonight that I feel just stands out in the Hard 14 is the conversation of the 3 Ps: pockets, pull, and pinch. And yes, Tackle Trading, that is absolutely going to be a thing. Pockets, pull, and pinch. And as moving averages go, what we're going to talk about here tonight is we're going to talk about the role of indicators very quickly. We're going to get into moving averages. We're going to talk about the origination of momentum. We're going to get into the 3 Ps of moving averages: pockets, pull, and pinch. And then I'm going to walk you through our July 4th holiday sale season as well, if you aren't inclined to take advantage of some of those educational products. So that you can navigate that market a little bit easier. It's always easier to navigate the market with a little bit of more knowledge than somebody else out there. Technical indicators are just that. They're an indicator that uses historical price action to determine where we think something is going to go in the future. Now I'm going to shove my video because I'm having a little bit of lag on my end. I'll turn it on here in just a minute. Now, technical indicators, there are 2 basic types of indicators. You have lagging indicators and you have leading indicators. And I'll tell you, there's many debates we have as technicians. I'm sure many of you guys would have had debates as technicians go. But as a technician, we'll debate things all the time. What does this mean? What does that mean? What does this data point mean? How does that impact the market? Technical indicators use historical price action to give us an understanding of that price action, of the momentum of the market, of the loss or the gaining of the momentum. Is it overvalued? Is it undervalued? And what indicators can certainly do is they can help us, they can provide context to the price action. They can provide perspective to the price action. And even though we make most of our trading decisions based on price, what is that candle doing? What is the trend, pattern, support and resistance? Buying a bullish retracement off after a narrow body candle at a support level. We typically make our decisions to make a trade based on price. It is indicators that can secondarily confirm that decision. And so when you're looking at the types of indicators out there, and yes, there are literally hundreds and hundreds of different types of indicators, but there's primarily just a few that everybody will utilize. Like, for example, a couple of examples of indicators. One would be RSI. Relative strength indicator. The RSI is a momentum indicator in the sense that it's tracking the momentum of the price relative to other instruments or relative to itself. And as it starts to increase that momentum, the RSI will start going up and up and up. And what it can really help us do, ladies and gentlemen, is it can help us understand if the buying decision we are making today is confirmed in the sense that, does it have room to run? We always have that question on a breakout, for example. It's breaking a resistance level. Does that stock have room to run? Well, a lot of that overbought, oversold is based on price, but what the RSI can do is confirm what we're seeing on price. Sometimes price can give us a little bit of a mishit. We need to be able to secondarily confirm that. RSI is such a beautiful indicator when it comes to giving us that confirmation for breakouts. Stochastics, a wonderful oscillating indicator between 0 and 100. It's got bands between 0 and 20 and 80 and 100. And it can be very, very visually understandable when something gets overbought, oversold. Stochastics, in my opinion, and this is just my opinion, but stochastics, the best way to utilize stochastics is from a longer term perspective, utilizing more weekly chart analysis to understand, is this the right time to start buying? Is this the right time to start selling? Stochastics can certainly answer that question, whereas MACD can help us understand the momentum in the short term, a wonderful momentum-based indicator. And then you also have indicators like Bollinger Bands. And as you can see, all of these indicators help us understand certain things. Is a stock overextended? Is it ready to buy? Does it have room to run? But mostly it helps us understand momentum and overbought versus oversold conditions. And again, what these lead us into is, are these an example of what we refer to as a primary trigger, meaning the indicator confirms your decision and you are using the indicator as a reason to get into a position or out of a position? That is a primary trigger. You're basing your trading decision off that analysis, versus a secondary confirmation is you are basing your trading decision based on the concept of technical analysis, price action, trends, patterns, support and resistance. And then we use this secondary confirmation through the indicator to confirm our decision we're making based on price action. Now, for the most part, and when I mean for the most part, I mean like 99.9% of the time, they are used as secondary confirmations. MACD is secondary confirmation, stochastics, RSI, the shaken money flow. All of these are secondary confirmation. Moving averages, and what the Hard 14 is predicated on, is in fact moving averages. What moving averages are they are a lagging indicator that uses historical price action. And so they do fit the bill of a secondary form of confirmation. And in many aspects of how we utilize moving averages, such as a trend following tool, or even as a catalyst of support and resistance, they are certainly just that, lagging indicators. They use historical price action. But like many forms of indicators, once you truly understand how the indicator works, you can use that indicator to help you front run a little bit of that secondary confirmation. And that's what I absolutely love about how Coach Mark puts together the hard 14 and how he utilizes the hard 14 from not only an understanding perspective and how we utilize that in lagging conditions, or utilizing it as a way to understand where support is and how support forms, such as the origination of momentum, or if we utilize them more as a leading type situation, a leading trigger based on pinches that we can put orders to front run that pinch. It can be utilized in both capacities, but once again, a deep understanding of moving averages is needed. And what we're here to understand today is not the deep, detailed understanding of moving averages. That's what the system is for. What we're here to understand is the basic concepts of moving averages, and obviously teach a few techniques for those of you that already understand how to utilize moving averages. Put a little bit of tools in your toolbox as well. When it comes to moving averages, the typical timeframes that we utilize within the hard 14 are two short-term EMAs. There are secondary moving averages in the hard 14, but the hard 14 literally is the combination of the 5 EMA and the 9 EMA. And so if you add 5 and 9, that's 14. Mark got to the hard 14 based on the 5 and the 9. And he tells a very detailed story of how he got to the hard 14 and how he created it in module 2 of the hard 14. But that is where the name comes from. It's the combination of the 5 EMA and the 9 EMA. Now, there are many algorithms, if not a vast majority of algorithms, that utilize moving averages in their algorithm, in their code, how they base their algorithm. And a lot of them use short-term EMAs, whether it's a 3 and a 5 or a 5 and an 8 or a 5 and a 9 or a 9 and a 13. The majority of those are 5 and 9. And so the 5 and the 9 EMA is the hard 14. It is also the two short-term moving averages from an exponential perspective that we utilize from a momentum perspective. And I think what Mark would agree with is that the hard 14, the combination of the 5 and the 9, anytime a stock gets in between a trending condition in the 5 and the 9, that is a buy signal in a bullish trend, and it is a sell signal in a bearish trend, and it is like clockwork until that stops, because the 5 and the 9 are the #1 most important momentum indicator in the market, according to the hard 14. That's the exponentials. Now, there's other EMAs, and EMAs are simply weighted moving averages. There's other EMAs that you will utilize. The 13 is a bridge moving average from an exponential perspective, but for the most part, the hard 14 definitely uses the hard 14, the 5 and the 9. Now, the simple moving averages they're not weighted. They're simply an average price action over time. And we use the primary ones that everybody utilizes: the 20 period, the 50 period, and the 200 simple moving average. Now, for those of you who are very new to moving averages, just simply understand this. They're really simple to understand. They can be a little complicated in how we utilize them, but in the understanding of them, they're pretty simple to understand. A simple moving average, SMA, is calculated by simply averaging the average closing price over a given time period. So you will always hear traders be like the 20-day, even if they're looking at a weekly chart, or the 20-day, but they're looking at a 5-minute chart. It literally, we just say 20-day because it's just, we've done this for many, many, many years, and that's just bad language more than anything. All it measures is the average last 20 candles, last 50 candles, last 100 candles. That's what it measures. EMAs measure the same time frame, but because they give greater weight, or they front load the current price action, they will be more prone to volatility shifts. And so when you're looking at these two moving averages here, the EMA in my example is colored red, the SMA is colored blue. And so as you can see, same price action, The EMA just is a little bit more sensitive than the SMA is. And we utilize them a little bit differently within the hard 14 as well. Now, when it comes to these moving averages, just think about the EMAs as a little bit of less lag. They're utilized a little bit more short term. SMAs are using a little bit of longer term price action, which means there's going to be a little bit of more lag there. Now, some simple pros and cons when it comes to moving averages and why we love utilizing moving averages is number one, they're algo powered. Like I said, the majority of algorithms out there are programmed, not the scalping algorithms, not Citadels or Virtues, which are just massive market makers, but the algorithms that are used at most hedge funds are powered through moving averages. For example, there was one time I was talking to a hedge fund manager who was basically programming an algorithm that would automatically buy and sell based on futures price action. And it was programmed based on a 1 EMA crossover of 2. And literally just looking at tick charts, cross up, cross down, they'd make millions of transactions constantly. They can't do that unless they're utilizing something that is very, very consistent. And there's nothing more consistent than those moving averages from an algorithm perspective. They give us objective signals. They help us understand trend confirmation. We can utilize moving averages to help us identify trading signals such as confirmation on crossovers, or where to place a stop loss, or where to get involved in an entry based on entering into a pocket. They can help us understand a tremendous amount of about momentum and who has that current momentum from a buyer's perspective or from a seller's perspective. Well, there's also some cons out there. Number one, they're lagging. They use historical price action. They're lag that tick chart. Well, yes, they do. 1000% they do. But what they can do is also provide a lot of context and perspective. They give you premature signals, delayed signals, false signals, over analysis, paralysis by analysis to a certain extent, and they can lead to over application. But how Coach Mark goes about it in the hard 14, he takes all of these traditional cons, and through his utilization of how his understanding of moving averages, all of these cons, in fact, do become a little bit of that pro column, because they get us to not make trades that we otherwise would make, but now we have a secondary confirmation. They add perspective to the trend. They add perspective to the pattern. They add context to all the price action that you're seeing. And there's a couple signals, especially from a longer term perspective, that can absolutely 100% help you understand where to start buying again in these types of market conditions. And I'm not talking about the market conditions of days long gone. I'm not talking about the subprime meltdown. I'm not talking about the dot-com. I'm talking about right now, this very second, in this current market condition, there are things happening that is giving us a little bit of bottom analysis in the marketplace, and moving averages are starting to help us understand that. And I'll take you through an example of that here in just a moment. Now, moving averages can be utilized for a lot of different reasons. They can smooth out price fluctuations. Absolutely. They can help us identify the direction of trends. They can act as support and resistance. In fact, moving averages, I still categorize 6 different catalysts from a support level. You have previous pivot points, old support equals new resistance, and so on and so forth. You have Fibonacci retracement numbers, Fibonacci extension numbers. You have trend lines, you have significant whole numbers, and you have moving averages. Moving averages, however, are becoming a priority within that categorization. And 5 years ago, guys, I wouldn't have said that. There's not a chance in the world I would have said that 5 years ago. I would have said, I would have put previous pivots ahead of that. That's horizontal support and resistance. I would have put, to some degree, Fibonacci retracement levels at the higher in that priority as well. I would have put moving averages 5 years ago, maybe third, maybe fourth in the priority of the catalyst or the strength of a catalyst. I don't think that's the case any longer. The way algorithms and how important algorithms have become in the marketplace, they represent over 90% of the entire buying and selling volume on a daily basis. They become more consistent over time. And even though we're seeing a tremendous amount of chop in the market right now, a lot of volatility, well, technical analysis, whether we like to see the picture on the chart or not, it's been pretty consistent, ladies and gentlemen, throughout the entire year. We've been dealing with a lot of bearish downtrends, a lot of pivot points. And whether or not we like those pivot points, it still has been a fairly technical, consistent year from a trend and a pattern perspective. And it definitely has from a support and resistance perspective as well. What moving averages can help us understand is where does that buying come in? They can provide some context for that as well. And as long as the moving averages are pointing downward, well, the market's going to seemingly continue to trend in the direction of the greater trend. And that greater trend right now is downward, even though we're still looking at a little bit of a doji at resistance here today. They can also be used as violations. And what I mean by that is when a trend is violated, when a pattern is violated, when a reversal occurs, a lot of times these moving averages will cross and give us a violation signal that would confirm the reversal signal we're looking at in the marketplace. Like I said, from a trend perspective, when you're looking at the short-term trend, you basically have 3 time frames of trends in the market outside of intraday analysis. You have short-term trends, you have intermediate trends, and you have primary trends. Short-term trends will last 30 days, 60 days, 90 days, but they're typically short-lived because they're based on daily charts that use pivot points on daily price action. And it's rare to see a consistent theme in the market that will last 3, 4, 5, 6 months and just see a consistent bullish uptrend or a consistent bearish downtrend. And so short-term trends are usually in that 30 to 60 days, but really it's based on pivots. The short-term trend or the short-term moving average we like to utilize to help us identify that not only the direction of the trend, but where is support within that trend is the combination of the 9 EMA and the 20 SMA. Now, the 20 SMA, tackle trading color coded, guys, that is color coded as red. The 9 EMA, that is pink. The 20 SMA, I know it says blue here, but that's just the example. The official coding is red, and the 50 SMA is blue. Again, the example is just the example, but color codes are, I'll put something out for everybody. We got to make this. We got to make this official. We got to have our version of a press release there, Chucky, to officially label all these moving averages the correct way. But once again, in the short-term trend, we are looking at the 9 and the 20. When you're looking at the intermediate trend to help you confirm the direction of it, the combination of the 50 and the 200 SMAs are really good to help you understand more intermediate trends. Intermediate trends can last upwards of a year. Primary trends are more market cycle based. They can last 4, 5, 6, 7, 8, 9, 10 years. The trend between the markets of 2009 and pandemic of 2020, that was about an 11-year trend from a primary perspective. And so they are truly longer term, especially when you're utilizing 200 days of price action. Your fast moving averages absolutely are those EMAs, the combination of the 5 and the 9 acting as a support level on the way up, acting as a resistance level on the way down. The 20 SMA is also a measurement of short-term analysis, as well as everybody here probably well knows by this point. Or he talked about the intermediate trends and long-term moving averages. The intermediate and the long-term trend is the 50 and the 200. Those are the 2 better moving averages. When they do cross, that usually leads to some buying activity as well. Now, when it comes to the moving averages and the hard 14, what I really want to talk about, because there's a lot of things that have been written and put out there regarding moving averages. We talk about moving averages all the time. Moving averages are a staple in almost every technician's toolbox. Everybody has a base understanding of them. Not everybody has Coach Mark's understanding of moving averages. And the couple things that I want to talk about for the remaining part of this webinar here is the origination of momentum. I want to get into the concept of support and how moving averages act as support. And the reason I want to do that is whether it's somebody fresh off the boat or somebody intermediate or somebody with an advanced understanding, the understanding of support is absolutely vital. And it's not a difficult concept to understand. And the utilization of moving averages that act as support is really, really, really good for newer traders because it's very visual. And when I was a young trader, I loved the advanced stuff. I geeked out on the advanced stuff. I would swim in an ocean of analytics and data and feel just fine. But that's when I was a younger lad. As I've gotten a little bit older, I don't want to spend as much time doing all that advanced technical analysis. I like the simplicity that Coach Mark teaches in the Hard 14. I like the simplicity in reversal analysis of understanding pockets. I like the simplicity in understanding that the 20-period moving average is a wonderful support level, and I don't have to calculate it. It's just visual there, right there on that chart. And so we're going to talk a little bit about support and resistance, very basic concepts that is a part of any technical trading system. We're going to get into the concepts of the 3 P's of moving averages, and one that I absolutely, and no joke, guys, I can't not see it. Once you understand what to look for, and again, it's not as simple as just, look at the distance between those moving averages, but once you know how to multiple time frame pockets, it just, you can't not see it. They truly do stand out to you. And it's one of those things that I've been telling people this for the better part of the last week when they ask me what my thoughts are on the Hard 14. It's just, there's certain things, once you learn them, you can't not see. And when it comes to technical analysis, there were 2 things, and I told the longer version of this story in our webinar last Thursday, but there are 3 things that really stand out to me on charts after I learned them. The first was potential average yield. Understanding how to target utilizing the personality of the stock was a game changer for me. It was an eye-opening game changer for me, and hopefully for countless others out there as well. Potential average yield was such an important concept that I learned from a great technician by the name of Jeff Crystal many, many, many years ago. Taught me how to see the personality of a stock. It was absolutely beautiful. It jumps out to me on every chart. If I can't see it, like literally, if I'm scanning on FinViz and I'm looking at 1,000 charts stacked on top of one another, I'm literally just going through boom, 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 boom. If it doesn't stand out to me, move on. Next chart, next chart, next chart. And that one stands out to me. Narrow body candles. Narrow body candles. I know it's a simple concept, but before 10 years ago, when we started teaching it, everybody else was teaching candlestick analysis based on the naming rights of a candle, what that name meant to the candle, how to assess that against the previous candles. Now, you know what you see? You see a lot of people going out there talking about narrow body candles, wide body candles. That wasn't the case 12 years ago, guys. Just simply wasn't the case. That influence came from Noah Davidson, and Noah Davidson gets a heck of a lot of credit in this industry for basically putting that out there. And I just like to be on his right hand on that conversation. And that stands out to me. Pockets stand out to me. Pinches are awesome, especially once you learn how to utilize them to front run order entries. But pockets are one of those things that just truly, truly, truly do stand out to me. And I hope they stand out to you and can help your trading along the way as well. When it comes to momentum in trading, I don't like to overcomplicate it. I really don't. If I see a big green candle, guys, and I'm just going to draw a big green candle, you know what? I'm going to say bulls have momentum and it should continue. I'm just going to say it. I'm not going to overcomplicate it. I'm not going to sit there and be like, well, what about this? And what about that? And what about this? I'm going to make an assumption that that big green candle knows more than you know. That big green candle knows more than I do. Price action is king, queen, and country, ladies and gentlemen. We swear at the altar of technical analysis to tackle trading. So I see a big green candle. Bulls have momentum. Momentum continues until it doesn't. It is simple as that. There's no over analyzing it. I see a big red candle. I'm like, oh, Look out below. Who's got control? The bears have control. They have control. Why do they have control? I don't know. I don't care. It doesn't matter. I'm never going to interview why they have control, because most likely it's just an algorithm and they don't have context or perspective, and they don't have the question of why the same way that you and I do. I'm just going to look at that big red candle. I'm going to say, bears have control. Momentum continues until it doesn't. And so momentum is a very, very, very powerful concept in the world of trading. And I have outside of the understanding of the creation of support and where support can form, I've never really gotten into the concept of where momentum originates. It's never really mattered to me to where it originated, because I never wanted to be the first and I never wanted to be the last. I was trained to wait for confirmation, both on the buy side and on the sell side. I never wanted to be the first to jump off the cliff. And because I was never the first to jump off the cliff, you always talk your buddy into doing that first. Kelly, shout out, high school, 18 years old. Unfortunately, I was the first in that one, but that's a long story. But I never wanted to be the first in trading. I always wanted to be the second, third, fourth, fifth trader. And the reason is you want to attach yourself to momentum. And so because as a swing trader, I never really cared about where or picking the exact bottom of something or picking the exact top. I could always be prepared when I see it. Well, the origination conversation always fell flat on my ears. Well, that kind of changed a little bit as I went through this with Coach Mark. This is not my system, ladies and gentlemen. I did not create this system. I was taught this system by Coach Mark. And I was the naysayer skeptic in this, as I always am when anybody brings any idea at tackle trading. It is my job to say, oh, that's not going to work. Why is it going to work? Let's break it down. And so Coach Mark brought me involved, and I was the one who was kind of the right-hand man in the creation of the Hard 14. But this is Mark's system. This is his intellectual property. This is his work over the last 10 years, quite frankly. And as I was going through it, I can only tell you guys my perspective as I was going through it. And the origination of momentum was one of the things that stood out to me very, very first. And it's one of those things that you don't know until you're older and you've went through some of what life can give you. I didn't know what I needed until I needed it type thing. Well, I didn't know how important the origination of momentum was until I started listening to Coach Mark for hours upon hours upon hours and upon hours of his research and detail and data on where the origination starts. And answering that question of why to me was so important. And it did, and it stood out to me. And so it became something that was very important to me. And Coach Mark talks about that in module 2 quite a bit, where he talks about why the Hard 14, why now. And I just absolutely loved it, because quite frankly, some of the best trading mindset I've ever seen is what he weaves into his educational content in his module 2 story of the why the Hard 14. And he talks about why he needed to answer for himself, not just so that he had faith in somebody else's system, but that he had faith in not only in his system, but in himself as well. And the origination of momentum was just so important in that conversation. The origination of momentum can be done in a variety of different technical ways. You can see the origination of momentum in the tick on any chart when any support level forms, but that's not the concept. If you think the origination of momentum is simply an understanding of where hypothetically a support level could form, that's not what the origination of momentum is. It is done through multiple different time frames, multiple different research. And what I'm going to love about not only the Hard 14 from a systematic perspective, going through that system, ladies and gentlemen, but what I'm going to love is those mastermind groups where we're analyzing that in the real time, constantly over and over and over again. But the origination of momentum certainly can be seen when you look at it on a chart. For example, when you're just looking at some of the basic understandings of momentum, not the origination, but the ongoing creation of momentum, you can help understand momentum from a variety of different ways. Indicators are fantastic for that. MACD is a wonderful momentum-based indicator. Price action utilizing wide body candles is a wonderful way to look at momentum, but so is the moving averages. And again, what I love about it is it's simple. For those of you that love simple, moving averages in the Hard 14 certainly make it simple. They take everything advanced, make it a little bit more simple. As you can see, the shorter term moving average here, the pink one versus the blue one, red one versus the blue one, as they are expanding on top of one another, that shows you increasing momentum, meaning the likelihood of that momentum continue is fairly aggressive. Once again, the hallmark of technicians. Things in motion have a tendency to stay in motion, guys. Once the market catches momentum, it's not a matter of whether we agree with it or not. It's that the market does. And we don't question Mr. Market. We don't question Mrs. Market. That doesn't happen. We accept what the market gives us in terms of the momentum. It is our job to utilize that momentum. And so when we see an increasing momentum condition, we certainly have a higher probability of that momentum continuing to move in the direction of the preceding trend versus a decreasing momentum condition. You typically have, and when those moving averages start to contract after expansion, that is showing you that the market is slowing down, that it is starting to die down from a bullish perspective. And the most likely scenario is you start to see a little bit of neutrality come. Moving averages, once again, we can look at that from price, but we can also utilize moving averages to help us understand that. In moving averages, the concept of support is not a moving average conversation. The concept of support is a universal conversation that we have from a market perspective of where is that area on the chart that the traders are coming to buy. Well, that area is called a catalyst. That's what a moving average is. It is, in my opinion, one of the number one or number two most important catalysts for a support or resistance level. Support itself is by definition an upward movement in price after a 3-day sell-off in the marketplace. And so to create a support pivot, well, you have to have at least a 3-day movement to create any pivot. And since support is a pivot, you have to have at least previous 3-day price movement to create a pivot. And so support by definition, though, is an upward movement in price. Where that level forms is the conversation that is very, very important so that we know where we need to look at to get involved in a trade or to get involved in a momentum 5 and 9 EMA bounce, or even if you switch out to longer time frames to get involved in those longer areas of support and resistance. So when you're looking at support, it is certainly the floor. It is the area on the chart where we expect the buyers to come in, but by definition, it is only created by price action. Where that floor forms is the conversation for the moving averages as the number one catalyst. When you're looking at the 5 EMA, the combination of the 5 EMA in trending conditions and the 9 EMA in trending conditions, I don't even think the biggest naysayer could disagree with the power that the combination of the 5 and the 9 have from a momentum perspective. Once it catches the 9, it rides the 9. Anytime it gets between the 5 and the 9, that's a buying opportunity. It's again, price action is king, queen, it is country, it is everything. When you're looking at the 5 and the 9, that is a beautiful combination support level. The 20 SMA utilized more in terms of your standard Goldilocks retracements outside of typical momentum condition. If you wanted to categorize a buy the dipper, have you guys ever wondered that, by the way? What does buy the dip mean? Have you guys ever categorized that? Have you ever said, ooh, that's a buy the dip opportunity versus, oh, I have no clue what that is? Or have you ever seen somebody say buy the dip after the market dropped 60%? Or have you ever seen buy the dip after the market dropped 6 cents? Like, I've seen it everywhere. I've seen people make arguments for buy the dip in every single capacity. When it takes to buy the dip, that dip is the combination of the 20 and the 50, ladies and gentlemen. Everything outside of buy the dip mechanics, that is either plug your nose and hold, or number 2, that's just a momentum drop and it got gobbled up by the 5 and the 9. The buy the dippers is the combination, in my estimation, of a market that is bullish, that is dipping in between the 20 SMA and the 50 SMA. That is that combination of buy the dip. For every true buy the dip, Like, for example, if you come to the 5 and the 9 here, buy every time, right? When you look at the 9, buy. Not as many trading signals, but you definitely have those. When you're looking at the 20 period, buy. And so when you shorten out, when you lengthen the time frame, obviously it's going to, smooth out some of that volatility that we see on the daily chart. When you're looking at the 50 period moving average, buy, wait 2 months, buy, wait a month, buy, wait a month, buy, wait a month, buy. They just don't happen very often versus the 5 and the 9 because of the momentum behind it. Those trading signals happen all the time. So in a momentum condition, those 5 and the 9, the combination of the hard 14, they have to be utilized in trading conditions with momentum. Without momentum, it's more by the dip mechanics when you're looking at moving averages acting as a support level. And then obviously the 200 SMA is just a combination of just it is the battle zone for buyers. There's no doubt about it. It is the battle zone for buyers. When it comes to resistance, on the other hand, same concept. Resistance is above the market. It drives the market back down. Resistance is by definition a downward movement in price. That downward movement in price occurs because after an overextended situation, after a rally, for example, like the market's doing over the last 3 days, well, all of a sudden, people start locking in profit. The supply side of the equation comes in. It's not the bears. Most of the time, guys, it's bull on bull crime. It's bulls punching it up. It's bulls and it's bulls trying to lock in profit as it goes down. That's the most likely scenario of why markets go up and down in a bullish uptrend, is because it is truly bull on bull crime. Bulls buying, bulls selling. And so resistance by definition is that downward movement in price. Resistance as a catalyst and utilizing that within the moving averages is what we call the slap down. Now, what I love about the slap down is it's one of those things you just can't see. You just can't not see. You see that market come into resistance and it's like, oh, slap down. See that market come into resistance, oh, slap down. It's just one of those things that will constantly just visually remind you of, you might not want to be buying at resistance in a downtrend. We might want to see that market break out of that level first. The slap down is real, and the slap down can be very punishing if you're trying to get in front of it. So what is the slap down? Well, the slap down is just a resistance test. That's all it is in a bearish downtrend. And because volatility works a little bit quicker on the downside than it does on the top side, that slap down can be a little bit more aggressive in terms of the volatility. When you're looking at a 5-minute chart, this is a chart on the S&P, down. When you're looking at Apple's hourly chart, look at the 5 and the 9 combination working as that momentum. Every time it gets in, just down. You don't want to fight that type of momentum. When you're looking at DraftKings, every time, look at that, boom, all the way down. Tried its best to double bottom here at 25, tried its best to break out of that 20, tried its best to break out of that 20, but it's almost like those moving averages work on all time frames. And that's something that you will notice over and over again. PayPal, same type of thing, catches that short-term, intermediate, long-term downtrend. And once that momentum persists, it is just down. Down fast, consolidate, let those moving averages catch up. Down fast, consolidate, let those moving averages catch up. Down fast, consolidate, let those moving averages catch up. It works on so many time frames. Now, the 3 Ps. The origination of momentum can just give you a tremendous amount of context over the creation, why support is created the way it does, where it is created, and where it does. And it just provides a lot of context and perspective to support, why it forms, where it forms, and how we can take advantage of that. But again, from even the origination of momentum, once again, I always wanted to attach myself to it. Now I want to understand those multiple time frame analysis, even as a short-term trader. And maybe this is one of the reasons I missed out on it for so long, was I was and still am a short-term trader. And so from that perspective, when you're a swing trader, yeah, you look at weekly charts, but a lot of times you're making some assumptions in the back of your head, like, Ooh, I know what that weekly chart looks like. I've seen this chart a million times. I know exactly what that weekly chart looks like. Well, what you don't know is all of the analysis. And so the 3 P's of moving averages, the pockets, the pole, and the pinch. What a pocket is it references the visual distance between 2 moving averages of like similarity. And what I mean by that is, for example, most pockets occur between, for example, they don't occur between the 5 EMA and the 200 SMA, for example. They might occur in short-term analysis between the 5 and the 9. They might even occur between the 5 and the 13, but not the 5 and the 200. They mostly occur between the typical like time frame. So the 20 and the 50 and the 200, the 5 and the 9, 2 moving averages that are fairly tight against one another, but because momentum has basically got out of whack one way or the other. Bears have a lot of momentum today, guys, but the reason bears have a lot of momentum today is because bulls stomped on their grave for 10 straight years and pumped up that market by 600%. And so, yeah, there's a lot of pockets here, and the bears have a lot of momentum, and one of those pockets is filling. Pockets emerge after overextended trend analysis, not patterns, guys, not support and resistance. Pockets occur after trends get overextended, after trends get underextended from the downside. That's what a pocket is. And so when the pocket happens, what you're looking for when you're identifying a pocket is once it gets into the pocket, basically what you're saying is over time, depending on the time frame you're looking at, over time, that pocket between the 20, the red, and the 50, the blue, will fill. And then as we see it enter into the pocket, we know we have the momentum. We have the belief that we're going to see it fill. Now, it's not going to go up in one day. It's not going to go up in 1 minute. It might do it through different patterns. It might do it in 2 trends. If you're looking at a weekly chart in your swing trading, you might be looking at that as an environment. You're going to be swing trading that stock 4 or 5 different times within that pocket, but you know you have the pocket, you know the bulls have momentum, and here's what you also know. Now that you're in the pocket, you know you got a big return potential, but what you also know is you got a foundation of support that you can build a house on, maybe even a city, given the fact that now you have the rising 5, the rising 9, the 20. All of those shorter term moving averages are now working with you in tandem with what you're trying to accomplish. And so pockets just absolutely stand out, and they can be very, very fruitful when you identify a pocket that it's going into, and then you're simply trying to take advantage of that. The same thing occurs on the downside. When you look at PayPal here, and PayPal's been a tremendous downtrend for a long time, ladies and gentlemen. Well, one of the problems that why PayPal's been in a tremendous downtrend is it was in a tremendous uptrend for a very long time. Look at the 200-day moving average here. Look at the 20 SMA average there. You're talking about hundreds of points on this weekly chart, ladies and gentlemen. Once you hit the pocket, look at the trend. Look at the gap fill. Treat pockets a little bit of the same type of philosophy that we treat gapping situations. It's not that every gap fills, it's just that it feels like every gap fills. Does that make sense, guys? Once again, it's not like every gap in a price actually fills the gap in price. It just feels like over time, every gap gets filled over time. And so I kind of treat pockets a little bit of the same. I don't know it's going to fill. I just know that oftentimes it does fill. And once we get into the pocket, then I can utilize my short-term skill set, utilizing the hard 14, for example, as an indicator as I play that to the downside from a pocket perspective. When you're looking at this, here's a pocket between the 50 and the 200. Here's a pocket between the 50 and the 200. Now, when you look at the current situation over here, what should transpire next? Well, we enter the pocket here, and here's what I love about these pockets, because they happen after extended rallies or extended sell-offs. You don't got to nail the first trade, guys. You don't need to get into it there. Like I said, once you enter in a pocket, you've had such a price appreciation that you can expect a little bit of sell-off here. Well, you got 3 or 4 trades there. I don't have to nail this first trade, which is extremely aggressive as we enter this pocket following this very big bullish uptrend. No. You can wait. Identify support. Once it breaks support, then you play the pocket. You can be aggressive here. You can also be a little bit conservative here and wait for that secondary pattern. Same thing here. Once it gets into the market, pocket fills. Pockets have a tendency to fill over time. When you're looking at the S&P, for example, and I want you guys to look at this. We're looking at a long-term chart, and we're going to look at the combo of the 50 and the 200. So I'm going to take off the 9. I'm going to take off the 20. We're going to take off volume. We're going to take off ATR, and we're just going to make this a naked chart using the 50 and the 200. Now, guys, let's go back subprime. Once we entered the pocket, did the pocket fill, ladies and gentlemen? Yes or no? Well, the answer is yes. It absolutely did fill. Now, was there other degrees of analysis we could have utilized in that? Absolutely, 100%. There's no doubt about that. We could have, but it was hard. It was difficult. I was there. I was active here going through this. I was screaming reversal, and yet it was so volatile, it was difficult to catch. Same thing occurred this year, by the way. Some of those trades were difficult to catch. But again, you're looking at a little bit of longer term time frame, enters the pocket, comes right back down. Let's move forward into the future. We enter into the pocket on the bullish side. Look at the head and shoulders formation. Look at that entry there. Did the pocket fill? Look at that fill. Pocket filled. Okay. Enters into the pocket. Does it fill? Absolutely. 100%. Let's move forward. Fight for the 50, 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 fight for the 50. First test, second test, third test. Feel like I'm having fourth breakfast here. That's fantastic. It fights for that because it knows what's going to happen once it violates it. Once it violates it, pocket fills. Moving on to the future. Fight for the 50, fight for the 50, fight for the 50, give up the 50 to the penny. First test, boom, pocket filled. Pocket filled, pandemic pocket filled. Now, the question I have for you guys is this. We entered into this pocket in January of this year. Actually, it was February of this year. We tested first test in January. We entered in right there on the February 14th. Thanks, Valentine's Day. Thanks, guys. Thanks, Valentine's. You entered into the pocket on Valentine's Day. All right, once we entered in, it's been choppy, guys, no doubt. But do you think there's a reason there's a lot of traders thinking 3,500 here? Do you think there might be a reason that there's a lot of traders thinking that 3,500 might be the battle zone for the buyers to come into the marketplace? Absolutely. Might there be a reason that a lot of us technicians think we might have one leg down more, but not a lot of legs down more? A lot of us are looking at that 200 weekly moving average as the buy zone, the same way we were looking at that 200-day moving average here during the trade war of 2018 going into 2019. Pandemic, that was too fast. Pandemic's a hard one to analyze historically because even though it filled the pocket, I don't care where that pocket was, it would have filled anything. I mean, we shut down our economy. We shut down everything. It was one of the most aggressive sell-offs I've seen in human history, quite frankly, when you're talking about the size of the market at that point. Look at it here, 200-day moving average, 200-day moving average. When you go back here, 200-day moving average early in the recovery. And so a lot of the pocket filling analysis and quite frankly, other analysis such as double top, such as Elliott wave, such as Fibonacci extensions, they all lead us into that 3,500 zone. But the beautiful thing about the hard 14, guys, is for me to truly understand all those versions of technical analysis, it truly has taken me 17 years of study to understand all of them. Not everything out there, just the ones I listed. Now, base understanding is one thing. Actually having an unconscious knowledge is a vastly different thing, and that's what I'm talking about. But moving averages, the hard 14, what Coach Mark has done in this system, it removes the complexity, ladies and gentlemen. And that's the truth. And that's why you want to be a part of the hard 14, is because it truly does remove the complexity of all technical analysis to make it far, far, far more simple. Now, gravitational pull is a concept where it helps us understand the concept of confirmation, that something tests support, and simply because it goes under support doesn't necessarily mean it's that until it closes. And so gravitational pull for me is not necessarily a game-changing concept for me. And again, pockets and pinches, those are out there too, but how Coach Mark utilizes them is truly unique. And there's nobody with more data than Coach Mark on this, I can promise that. But what gravitational pull will help me understand is fake outs. There are a lot of times as a short-term trader, we get faked out. We see a breakdown or we see a breakout and we want to trigger because we know what the momentum can do, and it comes right back down. And you always have to question, what happened here? Well, that's gravitational pull a little bit. And a lot of Mark's research brings into test, 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 but it isn't closed until it closes. You see it here, test, test, test. Doesn't close till it closes, that gravitational pull. And so that, more than anything, that's just what I wanted to bring up, is gravitational pull is when it tests under a moving average, brings it back up. And because short-term traders can have that understanding, it's more of a context it does provide us. Pinches are powerful, guys. Pinches are way powerful. They can be extremely momentum-based. They can be volatile in a very, very good thing. And especially when you got a bigger pocket on top of it, you can front run those bad boys and get in front of the algorithms. And I think that's pretty powerful as well. When you're dealing with pinches, ladies and gentlemen, it's the pinches of the short-term moving averages that come across some of those longer-term moving averages. And it puts the market in a pinching scenario where you can anticipate a breakout fairly aggressively. Now, what I like about pinches and what Coach Mark teaches you is how you can be aggressive within the pinch by putting order entries above the resistance breakout. So you're not getting in on the pinch crossover, you're getting in on the breakout of the pinch, but then where you put your orders, you're basically front running the analysis. You're saying, okay, I've identified a pinch, I'm putting my order in above the pinch, and if the market does go up and break the pinch of resistance, in this example, the 20-period moving average, we trigger into that trade. And again, what I like about pinches and is how we can utilize them to basically increase our own speed in how we can put those orders into the marketplace. And that's what a pinch is. You see another example here, pinch, you see the test, test, test. It doesn't close until the close. That's why we put that order in underneath those wicks to get filled as the pinch breaks and violates all that short-term analysis on daily charts, weekly charts, whatever you're looking at. Once it triggers underneath that, you have your order there. The cross confirms it, but your order's already there. Pocket gets filled. It preceded the pinch. The pinch led to the order. The order led to the pinch led to the order getting triggered. Pocket got filled. You are a happy camper. And ladies and gentlemen, with that said, that is the hard 14. And the hard 14 is a wonderful, wonderful, wonderful new trading system for tackle trading. It is a premium system at tackle trading. And like I said, ladies and gentlemen, you have freemium, you got subscription, and then you have premium at Tackle. We put a lot of content on the Tackle Trading YouTube channel, for example, definitional videos. We do the halftime report every single day. We put out Trade Masters on Wednesday. We got a lot of freemium content on our YouTube channel, but we also have a tremendous more content in our pro membership as well. And then when you talk about the premium of tackle trading, that is all systems, mastermind groups, and coaching. And like I said, ladies and gentlemen, We always go on discount for our premium systems over the July 4th holiday season. We also do it over Christmas as well. And so if you're looking at getting involved in the Hard 14, and I think you guys are going to absolutely love being a part of the Hard 14. And remember, any premium system at Tackle Trading is not just the on-demand and the recorded videos, that self-paced learning everybody loves doing, but it's also the mastermind groups every single month. You get to sit down in the mastermind group. They're all recorded as well. And so when it comes to the sales we're putting on for July 4th, I'll get into that here in a second. For the Hard 14, ladies and gentlemen, every one of our premium systems are based on 6 modules, right around 6 to 7 hours in length. And in the 6 modules, you're going to be focused on moving average basics. Magic lines are they answer the why of why moving averages, guys. Module 2 does. How to play bounces, moving averages and resistance on a multiple time frame. Module 5 is my favorite module, but module 6, he almost did better. And so module 5 is my favorite modules. I love pockets, pull, and pinch, especially pockets and pinches. Momentum in motion, though, he was in motion. He was an artist in motion in module number 6. Absolutely love it. You also get access to a manual. You get lifetime access to the mastermind group every single month. And you also get access to the Discord Hard 14 channel for that as well. In terms of the Hard 14, once again, guys, not only the system, but you get access to the mastermind groups. The first one we're doing is on Wednesday of this week, and we did put that in concrete here, ladies and gentlemen. The last Wednesday of every month is going to be the Hard 14 Mastermind Group. We did that because Coach Mark really either wanted the first of the month or he wanted the end of the month so we could look at those monthly candlesticks, those monthly candles from an origination point to make sure that he's sharing all of that with you in the right time frame as well. So you can get access to the Mastermind Group. Again, all premium systems have that in it. Like I said, the Hard 14 has 6 modules in it. Module 1, moving average basics, 2 magic lines, 3 moving average theory, how to play the bounce, both in terms of bullish and bearish reversal patterns. When you're looking at resistance and support, that's module number 4. The 3 P's of moving averages, pockets, pull, and pinch, that's module 5. And then module 6 is momentum in motion. And like I said, ladies and gentlemen, we are running our sell. Our typical price for our premium systems is $14.97. We're running that on discount at $9.97 for all of the premium systems out there. And once again, it's not just the Hard 14, but definitely is the Hard 14. And I'm putting the link to the Hard 14 storefront. It's tackletraining.com/store. Premium Hard 14. You can get there by the QR code here, as well as bit.ly/get-hard14. You can get that all for $9.97. Once again, that comes with lifetime access to the mastermind group that Coach Mark will be doing every single month as well. Oh, J trades, absolutely. Once a pocket's filled, doesn't mean that pocket's not going to continue to go down, right? The pocket is just filling in that capacity. In 2008, it came all the way under everything. And when you get under all the moving averages or above all the moving averages, J trades, that is a really good momentum condition to be in. That's called clear air. And he talks about clear air quite a bit in the Hard 14. But yeah, that's a clear air situation. They happen on the upside too. Once all the moving averages contract to the low point, once you get in that clear air to the bull side, ooh, it gets really sexy really fast there as well. So guys, if you're thinking about the Hard 14, this is the time to go ahead and be a part of that system. Once again, the mastermind group on Wednesday will be recorded. Every one of our mastermind groups is recorded. So you can definitely get access to that, even if you're not a part of the 14 in between now and then. Again, we run our sales for the next week and a half or so. So you can definitely get access for these discounts for the next week and a half. And if you need any help, guys, like I said, we're putting everything on discount. We do it every July 4th. We do it every Christmas holiday sale season as well at Tackle Trading. That's the 2 times we do these massive sales. And so if you're wanting to take advantage of any system we put out there, the Bear Market Survival Guide, ladies and gentlemen, is a wonderful system Coach Tyler Craig created a few years ago. go. Cash flow condors. If you've ever wanted to learn how to do bull puts, bear calls, and the iron condor, there's not a better system out there than cash flow condors. I can promise you that. The way Tyler approaches options is better than anybody else. You're definitely going to want to be involved in that. Short-term trading, that's all me, baby. That's all me. Swing trading, the step system. I'm the step system author and creator. And so I don't do the masterminds because I'm usually doing something else. But Tyler did the mastermind, for example, tonight. I know some of you attended that mastermind earlier tonight. And then the Hard 14 is the latest one in the moving average. So definitely check that out. Take advantage of all the discounts we're rocking at Tackle Trading. And if you need to talk to one of the coaches of Tackle Trading, you can always sign up for a consultation at tackletrading.com/schedule-consultation. You can always get access to one of the coaches of Tackle Trading, Coach Sylvia, Coach Emily, Coach Tim. These people are not salespeople, ladies and gentlemen. They are coaches and traders. They are there to help you out, to answer your questions. And so if you need to talk to Coach Tim, you need to talk to Coach Em, you need to talk to Coach Sylvia, set up a consultation and talk to them about what your needs are. I promise you, they got ideas and they got suggestions and they can certainly help you out. Even if it's just a conversation on what do I have access to? We have a lot of content in Tackle Trading. There are a lot of different ways to move forward with Tackle Trading, ladies and gentlemen. So definitely set up a consultation if you need. Those coaches will absolutely take care of you. And with that said, guys, thank you so much for being the absolute best part of Tackle Trading. I appreciate everybody in our Tackle Trading community. We are a community of like-minded investors and traders, helping everybody navigate the world together, or the financial markets together. And what our core value is education, ladies and gentlemen. We put out more education than any other company out there. We put it out there for the masses. We price it for the masses. We want to help the masses out there. And so if you're looking for a home that you can help navigate the financial markets with, you found it. It's tackletrading.com. You guys are the absolute best. Take advantage of this, the discounts, ladies and gentlemen. There's not a better value from an educational perspective than those premium systems and the coaching. Honestly, guys, we don't get a lot of negative reviews in our coaching. In fact, we've never had one, ever. We have never had a negative review in our coaching, at least that I know of. I've never been informed of a negative review in our coaching. Premium systems are above reproach. You're going to absolutely love them. And we work with you guys until literally, even after. We're always here. You need us, we are here. Couple reviews. These guys are the best. Thank you. That's all I'm going to read on that one. We are the best. We are. I agree. Thank you. Here's one from Rita. I love Rita. The resources and coaches are excellent, and they help traders of all levels of experience to succeed. Tackle Trading is a like-minded community, but we do have traders of variety of different skill sets, both from an advanced to a very, very, very beginning level. And what I've always told people is this: if you're a part of a community and there's people in that community that help you find your success, you got to pay it forward by helping the new people, help them find their success. We do it together. We help each other out. We answer each other's questions. We help each other. We give each other ideas. But at the end of the day, we all take individual action. I love the Tackle Trading community, and I love how diversified the community is from an experience perspective. Tackle Trading is a great community. Lots of information to help on the path of active trading. Thank you, Bill Saunders, and thank you so much for being the best part of Tackle Trading. This is Coach Matt. Definitely get the Hard 14 from Coach Mark at tackletrading.com. I will be back with all of you guys tomorrow in the halftime report. We're going to break down some of that technical analysis tomorrow. You guys are the absolute best. Thank you so much for being the best part of Tackle Trading, and I'll see you tomorrow in the halftime report.